Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies. Here's your host, Craig Evans.
The Norris Group is proud to present our 18th annual gala, I Survived Real Estate, at the Nixon Presidential Library on Friday, September 12th. Since 2008, our event has raised well over $1 million. This year, we'll be raising funds again for Make-A-Wish, OC, and IE. Individual tickets are available now. To get your tickets, go to isurviverealestate.com or click the link here in the card. We would like to thank the following platinum sponsors: UDirect IRA Services, the San Diego Creative Investors Association, Douglas Brook Homes, MBT Productions, Realty 411, and DBL Capital.
All right, so we're going to get started now. Do I need to take this? I don't know whose you stole there. I'll hold on to it. How about that? We're going to get started. We're going to start first with our economic panel. We've got some old friends that you guys have known for years and are some of my favorites. And then we've got some new people that have never been to the stage with I Survive Real Estate. And I'm excited for you to meet these. Some of these have been friends of mine for a while. Some of them I just met, and we're having a blast. So first of all, I want you to meet Dan Wallach. Dan is the current CEO of Shepherd's Finance and a veteran of the housing industry since 1985. Dan was a former CFO of 84 Lumber, and he created more than $2 billion in lending programs for builders. Dan knows how to structure deals, manage risk, and keeps projects moving even in the toughest markets. Dan, thank you, my friend. Appreciate it. Next, we've got Oscar Way. Oscar is a deputy chief economist at the California Association of Realtors, where for more than 20 years, he's analyzed housing trends, affordability, and consumer behavior. His insights are regularly featured in the LA Times, NPR, and the San Francisco Chronicle, making him one of the state's most trusted housing voices. Oscar, thank you for joining us, my friend. And again, a man that to this room needs no introduction, but I will attempt. Doug Duncan. Doug is a former chief economist at Fannie Mae and has been named one of Bloomberg Business Week's 50 most powerful people in real estate. He's guided national housing and mortgage forecasts for decades and is one of the country's go-to experts on what's happening in the economy. Please give a warm welcome to Doug Duncan. All right, let's get started. So, Bruce was probably a lot cooler than me when he would do this, but we're going to go with this, okay? Even though I feel like I just fell in a hole here. They got me the short chair. I feel like I'm the kid in detention now. All right. Where am I at? There we go. All right. One of the first things that I want to kind of dive into, if I can get my right list here. Doug, I want to start with you. I want to ask, our investors have been watching, and we talked about this a little bit ago. Our investors have been watching about inflation, rates. You know, they're studying that closely. We'll get into later, and we can touch on it now, but we'll get into later about whether that's the big push and pull on the market as well. But what's your best case for interest rates for the rest of this year and through 2026? Nothing like putting you on the spot.
I guess the safe answer would be they'll go up and down. The Fed's going to cut. That doesn't mean long rates are going down.
Yep.
When they cut the first time in this cycle, mortgage rates went up.
Yep.
It really depends on the bond market's mood, in a sense. The moodometer could be applied to the bond market. Right today, they've basically forgotten about inflation. They're focused only on this fight with the Fed about lowering interest rates. So I would say chances are pretty good that they're about where they'll be for the rest of this year. And then the question is whether there's something that triggers them to start thinking again about inflation, because inflation is not at Fed's target. In fact, it's going the other direction. So if inflation continues to grow, Fed's going to have to focus on that, and that changes the direction.
So how much are they taking into, because the mainstream media, when they're talking about inflation, and then even, well, let me backtrack in that. Let me pause inflation for a second. When we're talking about unemployment, how much do you think that comes into play into Fed's decision on changing rates?
The Fed today is focused on employment, not inflation. So, and basically that was Chair Powell's speech in Jackson Hole, Wyoming, was to say, given the risks on either side of our dual mandate, we're moving toward focusing on the employment side.
So from what the mainstream media talks about, they're talking about the U3. How much of that are they looking at U6 to make their determinations, though?
Well, depends on who you talk to in the media. And I'm not here to make enemies in the media. I think what's going on now is a failure to fully understand all the implications of closing the border. So I was having a conversation with somebody in the cocktail hour about the fact that in the payroll data, you are to report everyone who works for you. In the benchmarking tool that got the attention on Tuesday, that excludes people that are not eligible for unemployment compensation. And illegal, undocumented workers show up on the first one because they are workers, but they don't show on the second one. So the 1,000 people, the 900,000 jobs that went away are likely to be illegal, people that were over-reported in a sense in the payroll data. So this is not a function of layoffs. This is a function of an underlying need to think through all the implications of cutting off immigrant labor.
Oscar, let me ask you, we were talking about affordability. So many people think that, and rightly so, rates will have a play on affordability. But in the state of California, because many people here invest and put their money in California, is California at a breaking point with affordability? I mean, we're seeing we're not at the lowest of lows, but we're close to where, to be some of the all-time historic lows for the state of California in affordability. Do you think we're at a breaking point, or will California start to see a new reality? Are we going to have to accept a new reality, maybe? Maybe that's a better way to ask that.
It depends on how you define a breaking point.
Okay.
Now, if we just look at housing affordability, the quarterly numbers that we publish on a quarterly basis, we actually reached, I think Bruce's slide shows, it's 15%, but we actually hit a lower point at 14% maybe about a couple quarters ago. We actually started bouncing back to 15%. Now, the third quarter number will not be available until, of course, sometime in October or so, and then, we'll see more numbers. But if we're looking at, the interest rates and, monthly payment and how much people are paying on a regular basis, it actually, in the third quarter, it's possible that we might actually start bouncing back. Now, the reason why I think it's bouncing back is because of, if you have been paying attention to some of the monthly number, our monthly median price, in fact, actually declined on a year-over-year basis for the third month in a row. Now, people might be panicking like, whoa, it's actually started declining on a year-over-year basis. It's something that we should be concerned about. The decline in price that we're seeing is only about 1 or 2%. So we started seeing some moderation, partly because of seasonality. But the other part of it that we typically don't talk about too much is, remember, the number that I'm referring to is the state median price. So that means it is the price right in the middle. So the question is, are we actually seeing some decrease in price, or we are seeing a mix of sales change? The mix of sales change could possibly be, well, maybe at the high end, the more luxurious properties, we're seeing a little bit of a softening in sales. And for the more affordable segments, maybe not as much. So that's why the median price actually dipped a little bit.
All right, so let me ask you, is that sales volume or sales number? As far as the amount of a singular transaction?
It's the sales number, the number of units sold.
Okay, transaction amount. Okay.
Right. Now, here's the thing, though, to keep in mind, though, and we do that on a yearly basis. And I'm glad that you brought up the odometer. I do have some ideas for you and Andrew. On an annual basis, we look at, we do a survey called the Annual Housing Market Survey. And we send out a survey, we ask about how many people are first-time buyers, how many of them are actually repeat buyers. And in the latest number that we saw that for 2025, the overall median monthly payment, overall, including first-time buyers and repeat buyers, actually dipped a little bit from somewhere around $3,200 to $3,010. So it's dipped a little bit for all buyers. Guess what happened to first-time buyers? The monthly median price for first-time buyers, which has a lower home price, the monthly median price in 2024 was somewhere around $3,400 or something like that. It jumped to $3,800. So that number actually suggests to me that, well, first-time buyers are actually having a tough time, like what your odometer says, but the all-time buyers or all buyers are actually paying less because of the the home equity increase. Now, all of a sudden, of course, this year we have some concern about uncertainty about the policies and things like that. So, and of course, we did have some fluctuations in the stock market. Maybe the high-end people, high-end homeowners actually pull back a little bit, and that's caused the median price to drop a little bit.
Okay. So this next one, I'll start with Dan, but really I want to make this available for all three of you, really. What risk do you see for a recession in 2025, and how would that impact housing prices? And then for this room, investor opportunities.
I'm sorry, just to be clear, in 2025?
2025 through the end of, so the remainder of this year and through the end of 2026.
Gotcha. Okay, so I think what's going to happen is I do think when we get to the middle of next year, I think we'll see lower interest rates. And I think that because, and I mean
short-term rates or mortgage rates?
I mean mortgage rates.
Okay.
And I heard what Doug said, and I think that's interesting. And my view on it is that Trump will get his way somehow and mortgage rates will come down. So if that happens, then I think the home building industry will be more productive than it is right now. And I think if you look historically, almost every recession and every reversal of recession, let's say, coming out of recession, is usually led by the home building industry. And I think this is no exception. So right now, housing is down, and I think housing will be coming up next year. So I think right now we're in a, somewhat of a economic lull, but still GDP is going up and, unemployment's not bad. So I just think it'll be kind of ho-hum, and then I think next year will be a better year economically. And for you folks in the room, I think there'll be more activity. I don't know that means that, it's going to be very profitable activity, but I think there'll be a lot more activity a year from now than there is now.
Well, all right, before I make comment, either of you want to chime in on that?
I think that I agree. We're likely to be more of a muddle through kind of an economy for next year. Part of it is there's a quirk in the way that the OBBA, I was trying to find a fancier way to say that, O3BA or something like a Star Wars tax policy or something. It's retroactive. The tax cuts are retroactive to the beginning of 2025.
Okay.
But no change in withholding was made.
Yep.
So what's going to happen is when people file their taxes at the beginning of next year, they're going to get a lot more money back than they thought. I saw an estimate the average household will get probably about $3,000 more back in tax refund than they're anticipating. That's kind of a sugar rush to the first half of the year,
Yep.
which might well offset some inflationary impact on household thinking. So we might make it through next year without a doubt.
Your agreement there, or?
Yes and no.
Okay.
And I'm glad you asked me this question because, I just revised our forecast a little bit on the economy. And I think I agree with both of you in the sense that now if you look at the year over year, whether we're going to see positive growth economically, we see positive growth this year, and then we see positive growth next year for 2026. If we go by quarter to quarter, I personally feel like, maybe the third quarter and the fourth quarter, we may be able to get pass by with a positive growth number. But in the first quarter of 2026, I'm a little concerned. I'm a little concerned because of some of the numbers that I've seen in terms of retail sales, in terms of, the inflation flaring up a little bit. Now, we haven't seen inflation flaring up, quite significantly. But I'm concerned about there's the odds of what we call a stagflation. That, I think the Fed definitely is going to cut. They're going to cut rate, in September, October, probably maybe even one more time before the end of the year. So 75 basis point. But at some point in the first quarter, maybe the second quarter, they probably will stop a little bit because of concerns about inflation. And that's when I am concerned about a slightly economic slowdown. And whether it's going to get to negative or not, it's really hard to say. I personally feel like we may actually have 1 quarter of negative growth. Technically, of course, with two quarters of negative growth, we are in a recession. But I think it's still very debatable whether we're going to get there.
Are you allowing go backs?
Absolutely.
Okay. I didn't clarify the rules up front. The other thing that I think has people thinking about recessions and that they're focusing on the labor market is if you put yourself in the position of the CEO of an industrial company that sells things overseas or buys inputs overseas, and today the president tells you the tariff on the 1st of October, the tariffs are going up 50%. And then the week before the 1st of October, he says, well, I didn't mean that. You can start to imagine the difficulty of making decisions on hiring or not hiring. What's not in the labor data are layoffs. There's not been a big drop. Unemployment went from 4.2 to 4.3%, which historically is full employment.
Yep.
But what's not happening is the private sector is not hiring. The only job categories that added jobs were healthcare and social services, both of which are either directly or indirectly funded through government. Right. So the private sector is waiting to see what's going to happen on the horizon with regard to tariffs.
Anybody want a second to go back?
Yeah, I have one other thing. I think if you think about your businesses out here, when we think about what he was saying, the low-end market is good in most places. And I think that's going to continue as long as, rents are high, then the low-end market for housing sales should be good. I think the problem we're experiencing right now in the building industry and in the real estate industry is the middle market. The upper market, these people, interest rates kind of don't matter. Either they're not making a payment or their payment's irrelevant. They're more stock market driven. But in the middle market, it's very interest rate driven. And I think that is the danger market for you now. But as I look at it, underwriting loans that we do today for construction, when I look out, at mid next year when these things are going to be built, I think the market will be attractive for the middle market as well.
You're gonna
This
sell
is good.
You're going to sell 4 million existing homes this year, roughly.
Say it again, sir.
You're going to sell about 4 million existing homes this year, roughly.
At the national level, yes, actually, it's
That's the same number that were sold in 1995. There are 80 million more Americans today than there were in 1995.
Yep.
That to me is a compelling story about why you should be in the business you're in.
So just a couple of things like that, Doug mentioned about, the job growth in healthcare primarily. One thing that concerns me a little bit, and that's why I'm a little concerned about, the possibility of seeing an economic dip is, yes, the healthcare industry is kind of carrying the job growth right now. But what I'm concerned about is, the bill, the Trump's bill that got passed. Medicaid could be cut. That means there could be some negative impact on the healthcare industry. Now, if that indeed actually happened, that could actually pull back the healthcare industry's job growth a little bit. So that's what I'm concerned about a little bit in terms of job growth. And as far as the middle segment of the housing market, I want to add a couple of things. I want to add one thing. From that same survey that we did, annual housing market survey that we did, we saw that as far as the number of years that people stay in their home before selling, it'll actually surge all the way up to 15 years. That's the record high that we have had in the last, since the beginning of the year. Now, the reason why it may have gone up to the highest level, people might think, well, people are staying in their home for a little longer. They're not selling because of that lock-in effect, because of the mortgage prisoner effect, whatever that is, right? I actually have a somewhat different feeling about that. The reason why it actually went all the way up to 15 years, it's not only because, yes, I think there is still a little bit of lock-in effect. But at the same time, what I mentioned earlier, the first-time buyers, the entry-level people who actually hold on to who have their properties, they are not able to move on to the next home because of lack of, because interest rate hasn't come down yet. But the other part of it is the people who actually purchased for the last 6 years, 7 years, because of them locking in at the very beginning of 2020, 21, they were going to wait a little longer. So who was selling? The people who actually stay in their house for 20 years or so actually pushed the year off 10 years a little bit longer. So we are actually missing those people who actually purchased home in 6 years, 7 years, 8 years ago, and those might be those people who actually purchased home at the sort of middle income level. So that makes it a little tough, and that could actually make the median price a little bit more volatile because we don't know exactly what's going to happen with the low end or the high end.
Don't forget to visit I Survive Real Estate for tickets to the event on Friday, September 12th. The Norris Group would like to thank the following gold sponsors: Keystone CPA, the Inland Valleys Association of Realtors, Pasadena Phoebe, the North San Diego Real Estate Investors Association, LA South RIA, NorCal RIA, the Wizard of the Wobbly Box, Andy Teasley, Shepherd's Finance, the Thompson Group, Property Radar, and White House Catering. The dinner wine is provided with a generous contribution by Rick and Leanne Rossiter. Hope to see you all there.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the hard money tab.